I think when we talk about Powell, the Fed, interest rates, we forget what this beast really is. It's just so objectively, empirically wrong. It literally is the definition of a cabal. It's the definition of a mafia-like control. That when this beast, this creature was created in December of 1913 by a cabal of bankers, they created a massive power transfer from the citizens and the government. But today, you'd think we'd have learned the lessons from that Lehman casino gambling leverage, and they had the Dodd-Frank rules to, centralize the clearing of these weapons of mass destruction, these derivatives. But you fast forward from that disaster in 2008 to 2025, and the derivative market has gone from 60 trillion in 2008, prior to that crisis, to over 600 trillion today. And again, you gotta let that sink in a second. In other words, we've learned nothing from 2008. We've increased the exposure and the leverage, which is already at 100 to 1 per contract, by 10x. And that's 6 times global GDP just on levered bets that Wall Street calls hedging, but it's just gambling. We have a crisis infinitely higher than 2008. If just 5% of these derivatives went sideways, the cost would be over 30 trillion, which is more than the entire GFC of 2008. It's just one of the type of waves that any smart sailor would be prepared for and have a GPS device and a life vest. But these banks are sailing blind with suntan oil and no life preservers. And we're gonna all drown if they screw this up.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Well, Matt, an absolute pleasure. We're sitting here on the campfire, but without the fire.
Yeah.
Well, the fire can be in the conversation. We'll see.
We'll see. Yeah.
We're sitting here in Switzerland, in Zurich. There's a precious metal summit at the moment. And I thought, well, since you're here, it would be amazing as always to have a conversation with you.
Yeah.
Because I appreciate you as a human being, but also as a commentator. I think you have a very good understanding of what's happening, but you're also able to articulate things in a very engaging way and making it understandable for like layman's terms, if I'm not mistaken in using that expression. But
Yeah.
So my first question to you, we've been I think last time we spoke was with Francis and Henrik, and this was maybe 2-3 months ago.
Yeah.
What has been on your mind since the last months?
Yeah, that was a fascinating conversation. I think when we did it, my internet went out 3 times in the interview, and I was watching it from afar. It was a fantastic double team by Francis and I and poor Henrik. And his book's come out. I haven't read it yet. We were talking about the DXY and the dollar and gold, and very important, different views, but ultimately very similar conclusions on where gold's headed long term, but different views on the dollar. I think we're going to follow up with another kind of follow-up on that with both Francis and Henrik soon. In the meantime, obviously we're always looking at geopolitics, inflation, all the catchwords, and now affordability is the new word, and the debasement trade. But a lot of it's wonky, and a lot of it is the same thing over and over. And what I've really been thinking about is the old stuff that's reheating again, the kind of le plus ça change, le plus ça donne chose. The more things change, the more they're the same. And I was trying to get back to, I'm a cynic, I'm bemused by it. I warn that my cynicism can color my objectivity perhaps, or maybe it informs how I look at things unfairly. But I'm also obsessed with facts and data and empirical support of my argument. And the 2 stories that I kind of wanted to start with to remind all of us to think about in the backdrop as we're trying to make sense of geopolitics, currency risk, precious metals, is the story of the Federal Reserve in general, not because I'm an American, but because the central bank, the Fed, is an important player. And it's an important player not just in current headlines, but in the very history of Western capitalism, which affects all markets, especially the home of the world reserve currency. I wanted to touch upon a few themes in the Fed. And the other thing that I'm seeing now, which reminds me of my younger days as a trader, is what seems like a complex, and it is complex, but ultimately very, I think, explainable monster. The Fed is the creature from Jekyll Island, but the other monster that's really on my mind is the derivative market. And the derivative market, again, can be complex, but we can simplify it with simple metaphors. In terms of the Fed, and again, I want to keep this, whether you're a scholar of central banks or you barely know what they do, I think the story of how the Fed works and what it does and who it's not beholden to, which is no one, is worth kind of keeping the landscape in mind when we're talking about the mechanizations of all that's going wrong. The Fed is the central bank for the United States, home of the world reserve currency. It has a board of directors. It has 12 regional offices from Richmond to Boston. It has very intelligent PhDs who work for it, who are really government officials, even though it's independent. But most importantly, it's part of the biggest wealth transfer, and I think corruption of capitalism in the history of modern capital markets. And that's a grand statement. It's very easy to be anti-Fed. And to make that sink home, I think it's important to realize that the Fed is a private bank. And these other 12 Federal Reserve banks are private corporations. And that the shareholders of those private corporations, reserve banks, are other banks, the two big to fail banks, in particular the New York Federal Reserve Bank. And these shareholders get a 6% dividend a year from these reserve banks. And that's not really federal, that's a profit margin for central banks giving to commercial banks. That's okay, so it's a 6% dividend. But the fact that this is a privately owned cabal, owned by shareholders that are banks themselves, who basically are part of this larger Federal Reserve, is only the first kind of kink in the armor. When you think about what the Fed does, it's very simple. When governments, whoever is in power, left or right, mostly left or right, never very much centrist, it doesn't matter red or blue, they inevitably run deficits. In other words, they're spending more than they can earn. And that's nothing new in the last many, many decades. But when they run a deficit and they need money, they issue IOUs from the US Treasury. These are just, I owe you money. It's from Uncle Sam. It's an IOU. There's not enough demand for those IOUs. So the Fed has to buy them. That's the role of the Fed. But where does the Fed get that money? And again, it's not an exaggeration. The Fed literally mouse clicks the money at the Eccles building. It takes, if it needs 500 billion, it types in 500 billion, hits enter, and voila, you have 500 billion to monetize Uncle Sam's bar tab. And so Uncle Sam has to pay that back. He pays interest back to the Fed. So usually the taxpayers help Uncle Sam pay the Fed, but who does the Fed owe money to? And this is the question that isn't discussed at all in civics or in constitutional law or at Wharton or Harvard MBA programs. The Fed that mouse-clicked that money out of thin air owes it to no one. So when you think about it, it's like that Dire Straits song, get your money for nothing and your mandate for free. They have this immense power to create money and be beholden to no one, and yet take a profit in the form of interest payments from you or myself as a US citizen and Uncle Sam. I think it's just important to keep that in mind, that when this beast, this creature was created in December of 1913 by a cabal of bankers, they created a massive power transfer from the citizens and the government and from sound money in one sweep of a pen by Woodrow Wilson in December 1913. And I think I'll close with, as someone who studied the Constitution, constitutional law, the very first article in the US Constitution is that Congress alone has the power over money creation. And more importantly, that money, to be safe for generations ahead, needs to be backed by a precious metal. And we've completely eradicated the Constitution, and we've created a profit source for a series of private bankers. And that is ultimately what the Fed is, how it works, and how it's so corrupted. Free price discovery, constitutional law, and fairness in every way. And makes a small minority very wealthy and very powerful. And I think that's just something I had to get off my chest, because I think when we talk about Powell, the Fed, interest rates, we forget what this beast really is. It's just so objectively, empirically wrong. The second story, and I'll end with this and go wherever you want to go, it's just been on my mind because I've seen this movie before, is the derivative market. You know, I was a young Dragon Slayer punk during the great pre and post great financial crisis, but we all kind of remember the headlines of Lehman Brothers. And they were telling the world that we're doing fine, we have a $600 billion balance sheet of liabilities and assets. What they didn't say is they had 34 trillion in gambled bets in these derivatives markets. And a derivative, without getting complex, is it derives from something else. And the asset, of course, in 2008 were mortgages on homes, which were packaged together and sold as a mortgage-backed security. And Lehman had the right to invest in those, but they did it through a derivative, which means it's just leverage. And you could have a $100 million position on mortgages, but only actually own $1 million in collateral. So you can make a levered bet 100 to 1 on these assets. And Lehman did that to the tune of 35 trillion. So on its face, it said 600 billion balance sheet, but it had a 35 trillion exposure to horse crap assets, which it was over levered because, hey, subprime mortgages never default. Mortgages never default. Of course, that went against them. And what was scary is there was a contagion effect because other banks were counterparties to Lehman, and then we had a banking crisis and then a bailout. But the net result with patient zero number one, Lehman, and then Bear Stearns, and again, doesn't get wonky, the net result because of one really stupid levered bet, which they called hedging by sophisticated players, but it's just gambling. Derivatives are just gambling. The net result was a $25 trillion bailout between the TARP program, the US Fed, and global central banks because the virus spread globally from one stupid casino play with uber leverage at Lehman. And why that's important in 2025 is that whole crisis that we call the Great Financial Crisis involved $60 trillion in derivatives across the globe. Today, and this is being very conservative, Egon would say it's double this. But today, you'd think we'd have learned the lessons from that Lehman casino gambling leverage. And they had the Dodd-Frank rules to, centralize the clearing of these weapons of mass destruction, these derivatives. But you fast forward from that disaster in 2008 to 2025, and the derivative market has gone from 60 trillion in 2008, prior to that crisis, to over 600 trillion today. And again, you gotta let that sink in a second. In other words, we've learned nothing from 2008. We've increased the exposure and the leverage, which is already at 100 to 1 per contract, by 10x. And that's 6 times global GDP just on levered bets that Wall Street calls hedging, but it's just gambling.
And what if you superpose to money supply?
What's that?
If you superpose that to money supply, the 10x?
Oh, it's appalling though. But it's an expansion of credit. So it is an expansion of the money supply, but it has massive counterparty risk if those bets go wrong, like they did in 08. Mortgages never default. These guys are saying massive leverage, 100x leverage, that whatever we're investing, whether it's interest rate swaps, credit swaps, currency derivatives, we're all so smart. We can go 100 to 201 leverage, make a lot of money. We're calling this hedging risk, but it's really just gambling. It's speculating. That works great when everything's fine. It falls apart if one of those bets, which they're all directionally involved in, go wrong. There are 4 banks, Goldman, JP Morgan, Bank of America, and Citi, who own 90% of these derivative boxes. And what's scary is you take a great bank like JP Morgan, which has 54 trillion in notional exposure to derivatives, but its actual net assets are about 2.4 trillion, and it has 200 billion in capital equity. So you're looking at 2.8 trillion in actual value versus 54 trillion in exposure to derivatives, which is significantly higher than anything we saw in 2008. Goldman Sachs, Citi, B of A, very similar. Huge notional exposure to derivatives, very small net assets and equity capital with massive exposure. And again, I only say that because if there is anything that goes wrong in rate volatility for interest rate swaps, if there's anything wrong in credits derivatives, which is like CMBS or commercial real estate, if there's anything wrong in other debt instruments or even sovereign debt risk or geopolitical risk, and they get their bets wrong, and they're all really betting the same way on the same signals, we have a crisis infinitely higher than 2008. If just 5% of these derivatives went sideways, the cost would be over 30 trillion, which is more than the entire GFC of 2008. Again, don't want to get wonky. I'm just saying these are casinos of gambling. These are gamblers masquerading as bankers with nice ties and Ivy League educations and huge bonuses. But really what they're doing is they're levering with sophisticated hedging techniques that Larry Summers said they're so sophisticated, these are the best and the brightest. But they blew up in 08. And I'm not saying they're going to blow up tomorrow, but the risk of another blow up is very, very significant. I guess I just wanted to start that with my cynical reminder of the things we saw back in 1913 that, by the way, didn't prevent the crashes of 1929 or anything else, and the absolute power transfer of the central banks, and then their little nieces and nephews, these commercial banks, who blew up the world in 2008, are doing more risk damage now than they did not many years ago, and this is not making the headlines. Again, we'll get into any other asset class you want to talk about, but these are the people making decisions. These are the practices and risk management and profit methods that supposedly are too big to fail sophisticated banks are doing primarily for the benefit of themselves and a small minority of their shareholders and ultra high net worth private wealth management clients, but to the massive detriment of 90% of the rest of the world. Whether you're in Amsterdam, a village in France, or Toledo, Ohio, these things have sickening ripple effects, and they're just not discussed. Again, the things that we did with the Fed or derivatives aren't discussed at business school, and they're not discussed in civics. And so, I just wanted to start with that reminder because it's been on my mind to answer you. Another long answer to a short question. But think about what the Fed does, how it really works. It's beholden to no one but itself. It mouse clicks money out of nowhere. It has huge power. It benefits a small minority. And then fast forward that to the current global derivative market, and we see an equally poisonous, grotesque mechanization in play that really is misunderstood and never discussed. And I just wanted to remind people of that because it's bothering me. It's been on my mind.
Oh, very good. I think that indeed it's all tying together. If we look at the central bank being kind of like the one that makes the rules of the game, and then the players kind of misusing that. Also from the Cantillon effect, right? Being very close from that source of money creation is also one factor. And one famous example is Warren Buffett, who doesn't own gold and who's been not leveraging, but longing like all those firms from a very like insider perspective. If we look at the factors that would create such implosion in the derivatives, what would you say would be the biggest contributors to?
Yeah, that's a good question. I mean, the biggest asset that is part of the derivative gamble, or the biggest trade, is interest rates, interest rate derivatives. And then there'd be currency derivatives second and credit derivatives second and third. But the vast majority are interest rate plays with levered bets on the direction of rates. You don't need me or anyone to remind most people that there's been a lot of volatility in rates. And there's this understanding or faith, ties back to the Fed, that the Fed controls rates and that the gamblers, the bankers can listen to Powell and know how to make leverage and arbitrage rate swaps with derivatives, which again, wonky. All I'm saying is interest rates affect the success or failure of these bets, these massively levered bets. So that would be a major trigger if we saw a sigma moment in the rate markets, which for 99% of the time moves smoothly. But anyone who sails a boat, 90% of the time the ocean can be smooth, but the 5%, 1% time where it's very dangerous, it doesn't matter how good a sailor you are, you're humbled by the power of the ocean. These bankers assume that there is no such thing as a rogue wave. There's no such thing as an uh-oh moment or an unforeseen risk, which of course we've seen them over and over throughout history. We've seen them over and over in the last 30 to 50 years. I think interest rates, which the Fed arrogantly presumes they can control, like a sailor controlling the ocean, is a very risky area because if you understand bond markets, and many people do or don't, that's fine. But what my conclusions of the bond market is it gets the last laugh over hubris. It gets the last laugh over central bankers. Because the bond market, the laws of gravity in the bond market, like the laws of physics, are bigger than the Federal Reserve Chairman or a central bank. And that at some point the bond market has more power than the Fed. The Fed can set rates, it can print money, it can pretend to control the rate market like a thermostat, but it really will one day be when the world catches on that they don't trust the IOUs of a sovereign like Uncle Sam or the US, and there's powers of lack of trust, which we can talk all the evidence of that, and one day the bond market gets out of control and yields spike when bond prices go down because there's less demand for those bonds. I'm not saying it happens tomorrow. It's a highly likely risk. It's certainly a colorable risk that a lot of these banks aren't prepared for. They think the Fed will save them. But if, for any number of reasons, faith, trust, which is hard to quantify, in Uncle Sam's IOU starts to really seismically shift to the negative, demand for those bonds will fall. When bond prices fall, the yields go up, and that's the real cost of debt. And that's the real risk in these derivative trades with these interest rate swaps and derivatives. That's one example of how things can go from the sublime to the ridiculous. Again, it's one of many, And we could spend a lot of hours on it. We could do currencies, we could do sovereign debt risk, but they're all derivative products that are being gambled right now. I'm more worried about interest rate risk because it's making headlines now, and it's not even chapter 2 of what could go wrong. It could be much, much worse. And that's the gloom and doom gold guy. I'm speaking as a former hedge fund guy, a former bond trader, a former risk asset manager. It has nothing to do with my views on gold, although they're all tied. I'm just saying I've seen this risk before. It's discussed at levels that even most bankers, because it is so complex, don't understand. And truthfully, no one really does. But if they don't understand it fully, they don't control it fully either. It's just one of the type of waves that any smart sailor would be prepared for and have a GPS device, an EPIRB, and a dinghy or in a life vest. But these banks are sailing blind with suntan oil and no life preservers. And we're going to all drown if they screw this up.
That's a great metaphor.
Well, that's just how I see it. Yeah.
I actually forgot what I wanted to ask because I just got stuck with
that. Like vivid imagery
I
there.
just imagine them like with suntan. Is it also like tied to this? What I think Ronny Schofler was also explaining earlier on in the presentation of the conference is that you have this divergence of bonds and the gold price where they actually moved in tandem. So there was this whole talk of, well, the world is de-dollarizing, there's less demand for treasuries. Well, that isn't true apparently because it's less aggressive bids, yes, but demand has actually risen in tandem with the price of gold. So it's a bit weird because usually it's kind of the opposite.
Well, this is in all fairness to Henrik's point, right? And you know, we disagree, but he damn well could be right. And that's what I like about an informed debate. He has a view that when fear rises because systems are cracking, you pick a safe haven. You know, when chaos rises, you pick a safe haven. Of course, gold loves chaos. That's, to me, a good safe haven. But mathematically speaking, there's more interest in treasuries than gold right now, despite a lot of things. I mean, central banks now hold more gold than treasuries. But what Henrik is saying is there will be an uh-oh moment at some point. We can't time it. He's calling, and I agree, for a frothy blow-off top. You can never time a market crash. You can certainly measure and track a market bubble. But as Jeremy Grantham said, timing that is really a mug's game. No one can. I can't. Henrik can't. But it's somewhat the law of mean reversion. At some point, this market crashes. And what he's saying is, and I'm simplifying, but it's true, and he deserves the defense, that if and when that uh-oh moment occurs in this massive, objectively obvious market bubble, there will be fear. And when there's fear, there will be a flight to the best lifeboat, to use another metaphor. That lifeboat would be the sacred cow that is the 10-year US Treasury, the tier 1 asset, the BIS, alongside physical gold. And he's saying you'll see a rise in bond demand. And of course, as a rise in bond demand, yields should be coming down. But yields can move in different directions. I think why we're seeing gold and bonds moving in a similar direction is there's a similar fear in the world. And to Henrik's point, when that fear manifests itself, U.S. Treasuries and the U.S. dollar indirectly will be the safe haven, the lifeboat. And gold will be too, but it will be the dollar first and U.S. Treasury first and the DXY spiking first before gold becomes really obvious. Because I think when these markets tank, there'll maybe a run to U.S. Treasuries. There'll certainly be a run to the U.S. dollar, and that's the whole DXY debate, that the DXY will go past 120, 130. My argument, it could be wrong, is there'll be an equal run to physical gold because we're already seeing that pre-crisis. Henrik's point, using the 2008 market example as well, but last time we saw an uh-oh moment in the markets, gold lost 30%. And it will do that again, temporarily.
But it regained.
It regained. Yeah.
There was like a V recovery.
Yeah, quicker recovery than the S&P. I think it's absolutely valid, which is why I don't really calling it a debate with Henrik or Francis. Francis and I, we're all pro-gold at the end. Look, by the way, gold will never go in a straight line, and there is volatility in gold. Anyone invests in it for the long term needs to be a big boy and a big girl about that. We talk about, we are in a bull market in gold. You know, people say the gold price is going down, 8%. I said, really, it's going down from 2,000 to 4,000 in the last 18 months. Gold's going down. But if there's an 8% retracement, that's like the end of the bull market. It's not. And I think I should remind, between 1971 and 1980, gold went from $35 to $850. That was a major bull market in gold. Huge percentage increase, much farther than this one. But in 1975, gold lost 50%. Although it was on its way to 850, it went down to 260 and then some. It had a major uh-oh moment as an asset in the middle of its bull run, is all I'm saying. So to say, even if you're very high conviction on gold, that it really only goes north is dishonest. But it can have cyclical declines in a secular bull market. And to Henrik's point, we could see a major retracement in gold, which for me is like, as Rick Rule said last night at dinner, it's like a fur coat. If it's gold on sale, buy it for your wife when it's on sale, but still buy it because it has value. If we see a buying moment in gold because of an uh-oh moment in the markets for liquidity or to cover margin or for any reason, I would just buy more, because the larger case for gold is it goes up because paper money goes down. And that's inevitable, because as Henrik and Francis and I all agree, when that uh-oh moment comes, when there's a crisis, the central banks will inject fire hoses of liquidity, QE to the moon, which will further debase an already debased dollar. That's the end game, as Paul Tudor Jones says, all roads lead to this. And I agree, and that's just another tailwind for the gold movement. But I think it might be different in 2025, 2026, 2027, whenever this uh-oh moment comes. And we clearly see the bubble. When it pops, there's all kinds of things that could pop it. When it comes, I think it could be arguably different than 2008. Because in the last many years since 2008, central banks have been stacking more gold than treasuries. We see a clear, it's not just conspiracy theory anymore, a clear de-dollarization trend. We see it in the petrodollar. We see it with the BRICS. We see it with net settlement. We see Saudi Arabia buying, selling oil in yuan. We see a change. It's not the end of the dollar, but we see a clear change, very different than pre-2008. We see a clear trend since 2014 of central banks net stacking gold and net dumping U.S. treasuries. We see central banks now, as of this moment, own more gold than they do U.S. treasuries, which was unthinkable years ago. We see oil outside the petrodollar at 20% global sales outside the petrodollar, unthinkable 5-6 years ago. So we see Morgan Stanley offering a 60-20-20 portfolio with 20% gold, unthinkable pre-08. So what I'm saying is there's evidence that gold is far more necessary as an asset than it is contrarian as it was pre-08. And that's why I argue it's very possible that the next uh-oh moment will see actually, possible retracement in gold. But I think we actually could see a run to gold in a more institutional way than we did in the 08 crisis. That's my theory. I don't know. It could be a major uh-oh moment for gold temporarily. That doesn't bother me because it's a buying opportunity. Because again, in a major bull market in gold, which we're clearly entering, you can see retracements. If you understand the reason for holding gold and you're not buying and selling for a quick trade and you're not trying to speculate in a quarterly fashion, it really shouldn't shock you. But I wouldn't wait for that retracement before you get in, because that could be a retracement of 30% when gold's at 8,000 or 9,000. When Henrik and I met in South Africa, gold was what, 2,800, 2,700 earlier this year? And if there was a 30% retracement then, he would have been right. But if you waited for it then, you'd have missed out on the rise to 4,000. If we saw a 30% trace today, it'd still be higher than it was when we met in South Africa. So you can't time your entries. If you understand the longer term reason for holding gold, again, simply put, it's insurance for dying paper money. It's life insurance for dying paper money, the evidence of which is literally everywhere. It's way past the gold bugging camp. Even the Bitcoin crowd, which I respect, understands that. So, it's just one insurance policy against an openly, obviously dying fiat currency system from the debt-based disaster. So if you understand it that way, you're not going to be worried whether you bought gold at 4,000, 3,700 or waited for a pullback, because I and many others beyond just the gold camp, which are obviously in our bias circles, in our yes circles, and possibly could be guilty of data searching rather than data analysis, data digging just to confirm our own biases. But I think most of us inside and outside the system see gold at 10, 12, 15, 20. I was talking to Pierre Lassonde. He's obviously a clear expert in the mining space, but he could say with a straight face, in our lifetimes we'll see $20,000 gold. Does that mean it's tomorrow? Does that mean gold doesn't go down? No. Does that mean I'm absolutely certain? No. But that's the conviction I have, because gold can go to those levels only because fiat money has really no options left. And that's why Bitcoin and anti-fiat solutions, cryptos, have been getting so much momentum, and you don't have to be anti-Bitcoin to be pro-gold or vice versa. But for me, gold at 15, 10, 20,000 is the real end game. And even then, I save in gold and spend in fiat. It's insurance. That's it. It's a preservation asset. It certainly can go up in price optionality. But Egon, my colleague who bought gold at 300 decades ago and sees it at 4,000, isn't doing a victory lap. He still saves in gold. The price has changed, but you're measuring the price change in fiat money. You might as well be measuring in something like chickens or anything else, or polo ponies, whatever. It's not really a good measure of the value of the asset. It just holds its value better than the dollar. Long-winded way of saying, yeah, I'm holding it for the long term. If it has retracements, even 30%, I'll use those as buying opportunities. Yes, I'm selling my book. Yes, I'm gold biased. And yes, you could have a different opinion on that. But I think the very fact that the Bank of International Settlements, the IMF, even whales like Morgan Stanley see this, and they see it because their clients see it. And they see it because the writing's all over the wall now. It's no longer, again, a gold bug apology. It's the motions of history, from Adolf Thiers and Sir Thomas Gresham to Reinhardt and Rogoff to von Mises. I mean, this is just another credit cycle, and it means it's another fiat currency cycle. We saw that, and I'll end with this. We saw that in Rome in 280 AD. We fast forward to Portugal under King Philip II, a great empire. We saw it a couple centuries later in France in the 1870s, great empire. We saw it in the United Kingdom, a great empire done by 1920s. And we see the US right now. None of this means it's the end of Rome or the end of Lisbon or the end of London or the end of France. But they're not the powers they used to be. The world changes. And it's not the end of the United States, but it's going to change. Its hegemony, its leverage, its supremacy is already changing. And again, relatively, it's still the strongest economy, the strongest global GDP. It's not going to just wither on the vine, but its leverage, its power, its currency are being debased in plain sight for those who take the time to look at it.
Mm. And so would you say that this move you described from when gold went from, what was it again, $30 to 800, and this within a 5-year span or 8-year span?
It's a 10-year span from really basically 71 when we went off the gold standard. By the way, Nixon said, your dollar will be worth just as much tomorrow as it is today. And this is a temporary measure. That's what he said in 1971. And they also said the gold would actually go down. So there was 3 problems with that. A, it wasn't temporary. It's 54 years later and we're still not on a gold standard. B, the dollar lost absolute purchasing power in that next 10 years, 75%. Absolute, not relative to other currencies, but in absolute purchasing power, the dollar lost 75% from 1970 to 1980. And the gold price didn't go down. It went up from 35 to 850. What I'm saying, in that 10-year period, midway through, gold tanked 50% in 75. So for anyone to be an honest fiduciary about gold and say that it basically only goes secularly north once it's in a run and once currencies are debased isn't being honest. And you have to, if you respect the asset, recognize that it has moments of faith-losing volatility, and it shook a lot of folks out. And again, it could in the future see a major retracement. I hope it doesn't shake me out, because I hope I keep my eyes on how the past is prologue. And as long as I see more and more evidence of desperate governments with no solution to fiat money, I'm going to stay faithful to my gold. I think by the time we see the next real crisis, though, the IMF and the central banks of the world and the BIS are already kind of telegraphing that gold's going to be part of a new system. Whatever that system is, however disorderly or orderly it is, it's probably in the form of a central bank digital currency of some form. The IMF literally has a graph of it on their Bretton Woods 2.0 page on their website, and at the base of that graph is physical gold. Because even for something as awful as central bank digital currency to have any validity, they know now in this new crisis to come, which they helped create, and they blamed on COVID, they know now for that central bank digital currency beast to have any credibility as an efficient settlement policy, it has to be backed by a hard asset, and they put gold as the hard asset there. And that's why the BS and everyone else, BIS, is making gold a tier 1 asset. They're programming us serfs for the moment when centralized currencies are coming in, and they're going to back that in some coverage ratio with physical gold. I'm quite convinced of that. Quite convinced of that. They've already told us so, because they have no other asset to back it with hard asset. Cryptos are a whole other story. It's a whole other rabbit hole. It's a whole other legitimate thing to discuss. But in terms of the system, I'm not a friend at all of the Bank of International Settlements. I'm not a friend of central banks in general. But I can't deny that they're stacking gold for a reason. It's not for jewelry, dental work, or wedding rings. It's a new systemic shift in how currency is going to be looked at, or really how real money is going to somehow weed its way back into the system. It won't be a gold-backed US dollar or yuan or ruble, in my opinion. It'll be gold as a critical part of a new centralized currency in the West and as a trading settlement asset in the East. And if the East and West ever meet, if that peanut butter and chocolate ever meet, gold will still play a role. Whether it does will be determined, but there will be an undoubtable role for gold in that whatever god-awful unnormal reset comes.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, security saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth.
It's been talked about a lot. This paper that the Fed published in August about the revaluation of their gold reserves that would fit in a plan to actually even maybe in some cases there was someone who, I think a senator or I don't know who exactly, maybe you know, was proposing to issue bonds, gold-backed bonds.
Judy Shelton.
Yeah, Judy Shelton, exactly. And then there's also this whole thesis that the chief economist from the administration, the Trump administration, Stephen Miran, who wrote a paper in November 2024 about the rewiring of a user's guide of rewiring global trade and reserve currencies.
Yep.
And he also proponed as like gold as the fundamental role in that. Why also did the U.S. not buy gold since then?
This is, well, you could make the simple, smug answer that the U.S. is too cocky, stupid, and proud, and they just can't admit, they can't see what these otherwise backwards developing economies like Russia and China have known for centuries and decades, that they're playing chess because they've been, I think, ignored and misunderstood for so long that they're seeing history better than the West. That's the simple answer. Some would disagree, but they've been stacking gold quietly where the rest of the world mocks those silly little Easterners. And that's one argument. The other argument is, well, first of all, we don't have an audit of what the U.S. has. Maybe it has infinitely more than 8,131 tons. Maybe it has infinitely less. Maybe there's something the U.S. knows, or certainly it wouldn't be surprised if they're not disclosing. I don't know. The argument that I would say, if we revalued the certificates we have, these 261 million ounces of gold and these certificates at $42 to the spot price of gold today, that would be a huge mistake unless we have a heck of a lot more gold than we say we do. Because at the current World Gold Council breakdown, U.S. theoretically has much more gold than Russia and China. That's an absolute farce. I mean, I don't think that's really believed by anyone in the space. China has infinitely more amounts of gold because of the way it produces it and the way we track it off the record than the U.S. does if we have 8,000 tons. And as Kissinger warned, if you revalue these certificates to spot, to basically make QE out of gold, you don't have to print money, you just revalue gold to spot. Those certificates can move up in value. You get a couple trillion, maybe $1 trillion, depending on the gold price, in instant money, instant liquidity that you can throw into the Treasury General account and pay off some debt for Uncle Sam. But if you do that, make sure you have the most gold when you do, because you're basically now taking your last bullet and you're going to revalue this gold and you're going to get a big chunk of liquidity that you'll burn through in probably one fiscal year at the current price. Why not wait till gold's at a higher valuation, A, before you revalue, and B, make sure, as Kissinger warned years ago, that you have more gold than your adversaries. Because if you revalue, well, that means China and Russia are going to have a heck of a lot more leverage in this new world order if they have more gold than the U.S. That's the $1 trillion if. My gold buggy weird nature is, I think Russia's not even listed on the World Gold Council. I think they have at least 12,000 tons. Could be dead wrong. Could be a conspiracy theory. Could be nuts. And we think, you know, between Alistair McLeod and myself and the work we've done, I think China probably has at least 30,000 tons. So that would make China far more powerful if gold becomes part of this new power game in currency or liquidity. And so, again, these are premises that could be wrong, but I have a strong belief that China has more gold than the U.S. That said, we'd have to conduct an audit first. And I don't know how much gold the U.S. has. According to World Gold Council, about 8,000 tons. Yeah, so we'll see.
Oh, we'll know when crap hits the fan.
Yeah.
So
let me just say one more thing. I'm sorry, You mentioned Judy Shelton, and regardless of revaluation or Kissinger and all this guesstimating on what's going to happen tomorrow, I think it's important to know that the very fact that Judy Shelton wants to, and she's very convinced we will, have a long end of the curve gold-backed U.S. Treasury, whether that happens or not, and she says it will, and I don't know, and you don't know, but the very fact that that's even raised as an issue in the new world we live in, again, unthinkable 5-10 years ago when the world still thought the American dollar was immortal and that we were the king of all things. The very fact that Judy Shelton's even introducing this idea and taking it seriously, what is she really saying? She's saying for our treasury to be trusted, it has to be backed by gold. Because if it's just backed by the US dollar, it's not going to succeed. So she's confessing out loud that we need gold to give credibility to our own IOUs. In other words, we need gold to give credibility to our unloved dollar and our unloved US Treasury. And I think that's an important thing to keep in mind.
Mm-hmm. So what do you think about this whole play? Because I had an interview with Michael Howell as well, and also other guests recently, where there was this idea that stablecoins would be the next source of demand creation for bonds, US bonds, and that could be seen as a desperate move to actually sustain demand that was already shaky for those treasuries. So what do you think is really going on?
Look, I've literally said in many articles I've written, the Genius Act is the desperate act, but it's also a semi-brilliant act. It's never what it says it is, but it's, if I were a desperate leader of a desperately broke, objectively bankrupt, but otherwise still relatively powerful country, and I knew that the world was empirically trusting my IOUs less, A, because I have so much debt, and B, because I weaponized the neutral reserve currency in 2022. If I were in those shoes, I'd say we need to find a source of demand, a sponge to absorb all these IOUs that we're spitting out, because no one trusts it anymore, because we're too in debt and because we weaponized it. So we need to find some new way to make this dollar and this US Treasury likable, or at least absorbed. Otherwise, we just have to keep printing more, and there's a limit to how much we get away with that. Enter the Genius Act, enter stablecoin, and enter JP Morgan and Circle Internet and fintech companies that can issue stablecoins. And it's a brilliant propaganda job, because they're saying JP Morgan, Circle Internet, these major beasts they're getting a huge king-making opportunity here. It's an insider trade because, hey, I'm going to give you guys all over the world, that really frustrated doctor in Istanbul, or that guy who doesn't trust his currency somewhere in Czechoslovakia, you're going to get an e-dollar, super fast, super transferable, super efficient. And we're going to give you this wonderful, wonderful e-dollar. What they're not saying is, well, you're going to give us $1 for that e-dollar. We're going to back it with a US Treasury. That creates demand for the US Treasury. That's great. It creates demand for the US dollar. That's great. So that solves a couple problems at a minimal level for Uncle Sam. It also means that, hey, I'm the fintech company, or I'm JP Morgan, I'm issuing you this stablecoin. You get a stablecoin with $1. I get your dollar, and I get to get interest on the US Treasury that backs that stablecoin. So I get an arbitrage worth billions of dollars annually to me, which is why Circle Internet is making so much money right now, because they're getting yield. Well, you get an e-dollar. You're basically buying US Treasuries and getting no yield for it.
You could say they're managing the risk of the yield as well.
Well, the other thing is, that's why it's so ironic. Again, this is why everything from the Patriot Act to the Genius Act to all these euphemisms mean the exact opposite. Because first of all, stablecoin is not stable because it's backed by US Treasury. We saw in 2023 the Sigma moves in the US Treasuries. They were crazy. They were historically unprecedented moves. So the US Treasury isn't necessarily stable. But for now, it's yield for the fintech. It's yield for JP Morgan and these stablecoin issuers. But it's not that stable in the long run if you think about the bond market the way I do. And it's not a coin. It's an e-dollar. So it really is, it's a kingmaker for JP Morgan and fintech. It is a semi-decent sponge for Uncle Sam to absorb some of these treasuries. I think it's a guppy solution to a whale of a problem. Even if they get 3, 7, 4, 5, 7 trillion in stablecoins issued, that's not enough to cover 38 trillion in counting in Uncle Sam's debt, but it's better than nothing. It's a Band-Aid solution. It's another executive order. It's another attempt, which is better than anything else has tried, but it's desperate to me. But it's fairly brilliant, but as usual, it's misrepresented. And as usual, it benefits the issuers and the insiders to the Genius Act. And by the way, if I see Cantor Fitzgerald somewhere behind the legislation, something, I tend to distrust it. That's just my bias. But it's empirically really not a great thing for the end user, the stablecoin buyer, other than it's a very quick transferable e-dollar, it's a wonderful thing for Uncle Sam, and it's certainly a fortune maker for the fintech insiders who issue these. And I'll just end by saying the same thing. Stablecoins are issued by fintech and commercial banks. That is still a central bank digital currency. It's just not issued by the Fed. It's issued by fintech and banks. And so what these politicians so brilliantly did when they issued the Genius Act in the same week, they said, we're also introducing an anti-central bank digital currency bill because we're protecting our citizens from the appalling natures of central bank digital currency everyone's afraid of. Well, they just gave you the same thing on the left hand by hiding on the right. Stablecoin is just a fintech centralized digital currency. It's just as trackable and programmable as CBDC. So again, it's meant to be complex, like the COMEX market, like the Federal Reserve, like derivatives. All of this is meant to be too complex for the average guy who's just getting the story that, hey, this is a really fast transferable, e-dollar, e-stable coin. It's not stable, it's not a coin, and it's making the issuers richer than you. And it's trackable, like the truck drivers in Canada. If you're worried about a usurpation of your privacy and your control for any reason because of what you think, what party you're a member of, what your legal but personal interests are, if you go against a centralized power, technically that's much easier to take than the dollar under your mattress. And so this is just all part of this other larger theme of centralization that always, without exception, follows desperation, which always follows cycles of debt. When countries are broke, they become more controlling because they see the sins that they've created and they know it's going to upset the masses. So they need to create a protection against those masses, and they need to divide those masses. They need to have a sense of control over those masses. And that's the far more cynical, again, evolution of my thinking from the Fed to today and from history to today, that debt-soaked nations become centralized nations, extreme left or extreme right. The demagoguery comes in, and some form of control is always following up. And with technology today, control is a heck of a lot easier than it was during Philip II or the Denarius of Rome or 1879 France. It's just, it's even easier to be controlled today than ever before, which is sad.
That's a very good point you make as well. I was also thinking about it this way, that the conglomerate of issued stablecoins, which are private companies at the end of the day, are regulated, and those regulators have them on a leash and can make them do what they want.
Yeah.
And the facade of being like just a stablecoin, as you said,
Right.
but on the other hand, having features of a CBDC, but you could say it's a DBDC, decentralized digital currency.
Yeah.
Bank digital currency, actually. I'm gonna coin that one.
There you go. I like it.
It's that it kind of goes back to kind of like the way cartels are operated and how governments use cartels to make them do the dirty work, or in a way some form of financial guerrilla warfare, or maybe I'm getting a bit out of topic here, but it's kind of like a thing that also kind of akin, and I'm just gonna add that what Trump is doing. Trump is just giving business to his inner circles. They are making plentiful amount of money through those crypto projects or the coalitions that they form, and everything around it, and that this is the ultimate way of enriching mechanism.
For those who follow Trump, I mean, I'm not anti-Trump. It's an insider trade. It benefits more than just Trump. It benefits the kingmakers, the fintechs, and the banks that issue these. It doesn't benefit the citizen. But the word cabal, again, sounds like this is Piepenburg and the gold camp just creating drama, creating fear, creating sensationalism. But that's why I started with the Fed. It literally is the definition of a cabal. It's the definition of a mafia-like control. I mean, Woodrow Wilson was terrified of these bankers that met out on Jekyll Island. He was literally terrified of them. They had more power than he did. Like the mafia has control of a corner of Queens or Brooklyn. They have control through power, fear, and money. Now that seems extreme, but when you see that a central bank, a Fed, which is owned by private banks, is a private bank with shareholders that are put in power, that are beholden to no one and can create money out of nowhere. You would think I'm making that up. That is a cabal. That is a mafia. And there's a left mafia and a right mafia. There's just a greed mafia. The politics are almost a smokescreen, because when things get desperate, whether it's the extreme left, which is full of nonsense, or the extreme right, which is equally full of nonsense, it's terrifying in the end for the citizens. which is why an analog pet rock like gold on a relative basis is safer for me. Still at risk in a world gone mad, but it's less risk to me than a digital asset. Now again, it's a very debatable point. The Bitcoin crowd would be upset. It's just the choice I've made. But either way, Bitcoin or gold, anti-fiat solutions to centralization. Francis Hunt would just say, hey, I know I'm going to be a slave. I at least want to be a rich slave. Like we've resigned ourselves to the centralization that all of us, you and I, are too small to fix. And we're not going to educate the world on what's really going on. They don't want to see it. But for those who have to look into this rabbit hole, it's a depressing, cynical place. There's very little we can do other than become our own central bankers, back our own fiat money with our own anti-fiat asset. For me, the best historical store of value is gold. For the new generation, I understand that to be crypto. And that's the history we're going to march through together. I don't have to be anti-crypto to be pro-gold, but I've chosen gold. Some would say it's just that pet rock, that I'm the guy playing with the cassette tape. Well, the Bitcoiners are streaming. In other words, I'm still thinking a mail in a mailbox is better than email, and that gold is just that old record player. That's a fair argument, but I've done a deep dive into technology. I see its power, but I still have done a deep dive into history, and going forward, I think gold is being stacked by central banks for a reason. I think it's going to play a role in my lifetime, and that's why I hold it in a hole of ground in Switzerland, right here. Yeah.
On that note, Matt, I also actually want to point out that I was thinking about that as well, thinking that the disadvantage of gold is also its advantage. It's non-portability, or its lack of portability means you can't just steal it just like that either.
No, it's true.
And if, for example, Bitcoin, well, obviously it can be very secure. There's many solutions, but let's say other cryptos. I mean, how many hacks have we seen that amount, if you total them up, about billions of dollars worth of hacks that just literally disappeared in click mouse, as you always say. But this time not created, but stolen.
Stolen,
well, in both ways, it's actually stolen. And yeah, I was just thinking out loud. We want to talk about France, but I think there's gonna be a bit too long of conversation otherwise.
It's fun to make fun of the French, but we'll do it next time.
We'll keep it when we're in France. Thank you a lot, Matt, as always, for perspectives and bringing it across like no other.
Well, thanks, Andre. It's always a pleasure. Always.
Alexei.
Scheiss.
That's a compliment because Andre is your son. So
yeah, my son is Andre. So, and he's actually flying in about an hour, so I gotta go pick him up. Son is always on my mind. He's a real headache.
That's what every son wants to hear from his father.
He'll get the joke. He'll get the joke.
Thank you.
Yeah.